Welcome to the Alger podcast. Following the podcast, there will be a brief disclosure. Hello, I'm Alex Bernstein, and you're listening to the Alger podcast, investing in growth and change. 2024 marks Alger's 60th anniversary as an investment firm. It also marks 30 years at the firm for Alger's CEO and Chief Investment Officer, Dan Chung. As such, we're doing a special series of interviews this year with Dan, talking to him about both his personal history at Alger and some of the foundational ideas of the firm that have stood so strong since the company's inception. Dan, thanks so much for joining me this afternoon.
Thanks, Alex.
Dan, for this first interview, I'm excited to discuss a subject that we really don't hear too much about, your early days as an analyst. What some people might not know is that you went through Alger's training process starting out in pretty much the exact same way as our first-year analysts do. So you started out as a research associate, right?
I started at the very bottom of research. I actually spent a week learning the back office. I don't know if that was a tradition in those days or not, but I started in the back office for a week before starting in the research department, which was the plan. As a research associate, I worked for a young analyst, and I was at the very bottom. The strength that Alger had then and still has is that the training program was a combination of a playbook of process for research, in guidelines on what to look for in a company specific to our investment philosophy, building financial models, which was actually totally brand new to me. I'd never really used. At the time, it was Lotus 1, 2, 3. But building models and then, of course, how to use them to gain investment insights that are useful. And then flip over to the people culture side. I mean, first of all, the freedom to go out and do the research on companies you were assigned and industries that you were supposed to follow in the real world. And that was tremendously exciting and interesting to me. I mean, I was going to conferences, talking to experts, talking to people in an industry and just learning as much about it as you could. You know, to get to go to a tech conference and see presentations by the leading technologists of the time, interview them or their associates, and then, of course, see whether what they're saying matches up with what they're reporting in their financial results or what they're reporting in terms of, for example, industry market share. I mean, it was all very exciting and a lot of learning and, very dynamic process. And so then it was something I was actually fairly familiar with from being a lawyer, which is the Socratic method was very much sort of the culture and process at Alger, which is you may be the new research associate, but if you were assigned a piece of research on a company, when you're presenting it, you're expecting basically to get 1,000 questions, probing, challenging, simply just trying to go deeper into our insights about a company. And I was actually well equipped to handle that part of it.
I know you grew up in Silicon Valley. Did you naturally gravitate towards tech?
I didn't actually start off in tech. I mean, my first assignment as a research associate working for an analyst, I think we covered contract manufacturing, some industrials, restaurants. We covered cellular phone companies and funeral parlors. That was under the category of industries that are rolling up and consolidating. We also covered trucking company, for example. But in our process, after passing the CFA, getting promoted to analyst and getting my own coverage, in those days, I got a small assignment, but the whole culture was really like, well, now you're an analyst, so now you get to basically be a hunter-gatherer. Go out, research, find the great ideas in the stock market. It's a wide open playing field. But technology came anyway with that small start.
And just to be clear, this is the mid-90s that we're talking about.
Basically, there was one name within the coverage that I got that was on every headline but wasn't really considered important by Wall Street, which was America Online. And just to give you how small it was, I mean, I think at the time the market cap of the company was essentially 200 or 300 million. It was a small cap company, but what I knew about America Online and through our investment philosophy of high growth in particular was that they were seeing tremendous demand and growth from consumers to get online. They were in the headlines not because they were having great success. They were in the headlines because they were having huge outages and failures, and we're getting a lot of criticism for that. But I saw the problems as likely solvable. I did research on that, including visits down to their data centers. I would ask the engineers and the data center managers, well, what are the biggest problems here? And they would walk me around and show me where their problems were. And then I took those back and did research, made connections, and realized that they had a good problem to have, which is so much demand that it wasn't that their technology architecture was incorrect or faulty. It was simply they couldn't install enough of it quickly enough with enough capacity to handle literally the hundreds of thousands that went to 10 to millions very rapidly, exponentially. And so they were just sort of having log-on problems. It was actually the first stock I recommended, I think, as an analyst. It ended up being a top holding. Not only that year, but in successive years, ultimately when AOL acquired Time Warner in, I think, 1998 or 9, towards the end of the internet era. So, I mean, that's how it all started.
What was a day in the life like for you as an analyst back then?
Well, we were certainly very paper-based there, even though we had financial models. They weren't really connected to anything. Like my desktop computer in 94, 95 was not connected to the internet. No one was. I had to actually ask David Alger to get an internet connection because our big holding was America Online, and also I was trying to pitch the stock. So we had one connection, and it was on a shared desktop, which I kind of dominated, I guess, because actually, frankly, a lot of the analysts were not particularly interested in it, or it wasn't their area, or they had other things to do. I'm not really sure. Getting financial data, manually inputting it, because you got the 10Ks and 10Qs basically through the mail, and then you carefully read them and input the data that you wanted into your models. That's a good part of the day. We spent a good part of the day on the phone calling companies or experts or industry participants. I spent a lot of time, and frankly, as a junior analyst, it's not like I could call the CEOs and CFOs. They wouldn't really pick up the phone call. But a lot of time on the phone. The standard practice there would be to read newspapers, read industry journals, look at press releases, and then for my research, note who was being quoted at a company, and then try to call them or contact them. Or in a newspaper article, not just looking at the New York Times, but looking at the local paper in an area. I remember spending quite a bit of time looking at papers in Virginia for a while because of the development of basically now the big office centers they have there. Calling the local writers of an article on business and then asking them for further insights on whatever they were reporting on. So a lot of time on the phone, a lot of time in front of the models, and then meetings. We had some big standing meetings that you couldn't miss. Meet with PMs, of course, if they want to. Fair amount of time also travel. Go to visit the companies at their headquarters, set up a bunch of interviews, try and get deep inside what's the character of a company and its insights. And I think we learned a lot those days because the companies, especially small cap, were often surprised that an analyst was going to fly like halfway across the country to meet just with them and spend a day with them. And don't just talk to the CFO and the CEO, but the head of sales, the head of manufacturing, head of R&D, whoever they would actually let you talk to pretty much. So I really enjoyed that, and I did do a lot of travel.
And what was it like for you when the dot-coms crashed? You were pretty young at the time comparatively. It must have been an intense experience.
Around 2000, the internet had sort of started to crack. David called, and the other PMs arranged for me to come in and say, look, we got to reorganize the tech portfolio. So what do we sell? What do we keep? And so I made a bunch of recommendations after a series of very big, intense meetings with the general purpose of cutting down the number of names and also potentially doubling down on those because they'd gotten cheaper. I remember we were successful in the first round of this because I had already gotten us out of Yahoo and thought that a lot of the consumer internet names had gotten just overextended in valuation and fundamentals were changing. And also we were worried about a consumer recession. But the thought that I had was the growth in the internet was still going to occur in enterprises, in corporate. And that, in fact, because they were slower to adopt, but things like online warehouse management, new kinds of cloud computing, and they weren't calling it the cloud then, but it's essentially the cloud. The idea was that companies had realized that the internet was going to change their architectures, change their logistics, to change that, how they ran their businesses. And so that stream of revenues and those companies that served it would basically grow through recession. There was a big bounce. A lot of those, what I call enterprise internet companies, rallied, but then it seemed like everything hit the wall. And so I remember going in and recommending the sale of a whole bunch more companies. And I said, David, I feel bad. I'm not finding any stocks that I want to buy and all of this stuff. And he actually said, it's okay. You carried the ball for a long time. It's time for other people in other sectors to carry the ball. You were minimizing losses and getting us out.
Dan, how did your experience as an analyst all those years ago inform your role today as Chief Investment Officer?
Well, meritocracy, giving opportunity to people, regardless of their age or experience, to show that they could contribute. Those were the hallmarks of the firm then. And I think preserving those attributes now is a major part of what I try to do with my partners here. It's not so easy because meritocracy requires some things that some people don't like, which is rigorous accountability, sometimes quantitative, sometimes qualitative, but nevertheless accountability for results and accountability for how you get to the results. I do believe that in a meritocracy, you also have to have a culture that people can be objective, and there's a whole culture that sometimes says, oh, well, try to avoid that in some way. I'm not sure why that really benefits people. And I think this is the most competitive business in the world. What other one is more competitive? Some people would say, oh, professional sports. No, they're not. The number of teams is limited. The number of players on the field is limited. All kinds of rules. That's the price for meritocracy. It takes a pretty unique set of people to understand why that's good for not only the firm, but good for them. I do think that's the hallmark of a boutique like Alger. And I've seen it at other fine boutiques too.
Dan, thanks so much for joining me today, and I look forward to the second part of our interview.
Thanks, Alex. Great talking to you.
And thank you for listening. For more information on how Alger can help you unlock your growth potential, and for more of our latest insights, please visit alger.com. The views expressed are the views of Fred Alger Management, LLC, FM, and its affiliates as of May 2024. These views are subject to change at any time and may not represent the views of all portfolio management teams. These views should not be interpreted as a guarantee of the future performance of the markets, any security, or any funds managed by FAM. These views are not meant to provide investment advice and should not be considered a recommendation to purchase or sell securities. Holdings and sector allocations are subject to change. Risk disclosures. Investing in the stock market involves risks, including the potential loss of principal. Growth stocks may be more volatile than other stocks, as their prices tend to be higher in relation to their company's earnings and may be more sensitive to market, political, and economic developments. Local, regional, or global events such as environmental or natural disasters, war, terrorism, pandemics, outbreaks of infectious diseases, and similar public health threats, recessions, or other events could have a significant impact on investments. Investing in innovation is not without risk, and there is no guarantee that investments in research and development will result in a company gaining market share or achieving enhanced revenue. Companies exploring new technologies may face regulatory, political, or legal challenges that may adversely impact their competitive positioning and financial prospects. Past performance is not indicative of future performance. Important information for U.S. investors. This material must be accompanied by the most recent fund fact sheets if used in connection with the sale of mutual fund and ETF shares. Fred Alger & Company, LLC serves as distributor of the Alger mutual funds. Important information for UK and EU investors. This material is directed at investment professionals and qualified investors as defined by MIFID FCA regulations. It is for information purposes only and has been prepared and is made available for the benefit of investors. This material does not constitute an offer or solicitation to any person in any jurisdiction in which it is not authorized or permitted, or to anyone who would be an unlawful recipient, and is only intended for use by original recipients and addressees. The original recipient is solely responsible for any actions in further distributing this material and should be satisfied in doing so that there is no breach of local legislation or regulation. Certain products may be subject to restrictions with regard to certain persons or in certain countries under national regulations applicable to such persons or countries. Alger Management Limited, Company House number 8634056, domiciled at 85 Gresham Street, Suite 308, London, EC2V 7NQ, UK, is authorized and regulated by the Financial Conduct Authority for the distribution of regulated financial products and services. FAM and/or Weatherby Capital LLC, U.S. registered investment advisors, serve as sub-portfolio managers to financial products distributed by Alger Management Limited, Alger Group Holdings LLC, parent company of FAM, and Alger Management Limited. FAM and Fred Alger & Company LLC are not an authorized person for the purposes of the Financial Services and Markets Act 2000 of the United Kingdom, FSMA, and this material has not been approved by an authorized person for the purposes of Section 21(2)(b) of the FSMA. Important information for investors in Israel. This material is provided in Israel only to investors of the type listed in the first schedule of the Securities Law 1968, the Securities Law, and the Regulation of Investment Advice, Investment Marketing, and Investment Portfolio Management Law 1995. The fund units will not be sold to investors who are not of the type listed in the first schedule of the Securities Law. The following represents the noted percentages of firm-wide assets under management as of February 29, 2024. AOL, 0%. Yahoo Inc., 0%. Warner Media LLC, 0%. The New York Times Company, 0%. Fred Alger & Company LLC, 100 Pearl Street, New York, New York, 10004, 800-305-8547, alger.com.